Imagine finding out that the world's most fearful investor could still have become rich. An investor who always only ever invested at the market's absolute highest point. Every single time everyone else was screaming, "A crash is coming, don't buy now." That's exactly when this investor put his money in, and research shows that if he simply never stopped investing, he would be a millionaire today. In this video, we're going to look at a real data-backed study that proves investing at an all-time high isn't nearly as bad as you think. Let's get started. Welcome back to the channel where we talk about money, investing, and real research. No fake tips, ever. Today's topic is fascinating because it's a fear that lives in the mind of almost every new investor. What if I invest right at the market's peak and then it crashes? This fear is so real that many people sit on cash for years, waiting for the right entry point. But what happens when we actually test this fear with data? Let's look at what real financial researcher Nick Maggiulli discovered. Nick Maggiulli, author of the popular finance blog of Dollars and Data, ran a thought experiment. He imagined two investors, investor A, the one with perfect timing. He only invests right after a market crash at the lowest possible point. Perfect timing, as if some higher power was telling him exactly when the market would fall. Investor B, the unluckiest person imaginable, he only invests when the market is at an all-time high. Every single time, from 1970 all the way to 2018, both of them invested a portion of their salary every single month. The only difference was their timing. What was the result? Shocking. Investor B, who always bought at the most expensive price, ended up only slightly behind investor A. The only thing that mattered was that both of them put their money into the market. Over time, compounding did the rest of the work. Here's an interesting fact most people don't know. Look at the history of the S&P 500. The market closes at an all-time high, roughly 5% to 7% of all trading days. That means if you only invest when the market hits a new high, you're not nearly as unlucky as you think. And here's another interesting thing. When the market makes a new all-time high, the average return over the following year has historically been positive more often than not. Why? Because the market is essentially a reflection of growth. Companies grow, economies grow, and new highs are a healthy sign, not a warning sign. Let's put this into real numbers. Suppose there are two investors, Alex and Priya. Alex is a smart investor. He waits for every dip. He only invests when the market falls. The rest of the time he keeps his cash on the side, waiting for the right moment. Priya is simple. Every month, without overthinking it, she invests $100, whether the market is at an all-time high or in the middle of a crash. 20 years later, research and historical backtests show, again and again, Priya, who invested consistently without worrying about timing, usually ends up ahead of Alex. Why? Because the time Alex spends sitting in cash waiting for the right moment is time the market spends moving on without him. So why is our brain so afraid of all-time highs? It's a cognitive bias called recency bias. When the market is high, we think it has to come down now because we assume whatever goes up must come down. But the stock market doesn't follow gravity. It follows company profits, innovation, and growth. There's another bias called loss aversion. We feel the pain of a loss about twice as strongly as the joy of an equivalent gain. That's why we're afraid to invest at an all-time high, because if a crash follows immediately, the pain feels overwhelming. But if you're thinking long-term, a small short-term dip doesn't matter at all. This is one of the most famous lines in the financial world, and today you'll understand why. According to one study, if you stayed invested in the S&P 500 for 20 years but missed just the best 10 days, your return would be almost cut in half. And the interesting part is, those best days usually come right after a crash, exactly when everyone has already panic sold and left the market. Okay, that's why timing the market is so risky. If you're out on the wrong day, you lose your entire return. And let's look at another extreme example, Yaman, the worst case scenario. In 1989, Japan's Nikkei stock market hit its all-time high. After that, the market didn't touch that level again for 30 years. This is considered the worst case scenario in the world for ATH investing. But look closely. Investors who kept investing regularly and stayed diversified, instead of depending only on Japan, still recovered through global markets. The lesson is simple. Diversification and consistency can protect you even in the most extreme worst-case scenarios. And let's break this entire research down into practical steps. Point 1, start investing regularly. Don't wait for the right timing. Research shows again and again, people who wait for the perfect time usually end up sitting in cash for far too long and miss out on growth. Point 2, diversify. Don't depend on a single stock or a single country. Point 3, keep emotions out of your trading decisions. When the market crashes, fear kicks in. When the market is high, greed or fear can both show up. But data-driven decisions consistently outperform emotion-driven ones. Point 4, keep a long-term horizon, at least 10 to 15 years. Point 5, consistency beats perfection. Now here's something important to understand. This video doesn't mean you should buy anything blindly. This research applies to long-term diversified index investing like the S&P 500 or Nifty 50, not random speculative stocks or crypto. Individual companies can crash and never recover, but broad market indexes have historically always bounced back. So do your own research and, if needed, talk to a qualified financial advisor. What's the biggest lesson from this entire research? That finding the perfect market timing is a myth. Even professional fund managers with entire teams, data, and AI models consistently fail to time the market. So if the professionals can't do it, it's even harder for a retail investor. The thing that actually works is discipline. Investing your money every month without emotion. Warren Buffett, one of the most successful investors in the world, has given the same advice over and over. His famous line is, "Time in the market beats timing the market." He himself continued investing through market crashes with his own company because his focus was never on short-term price, but on long-term value. Let's put the whole video's lessons in one place. 1. Investing at an all-time high isn't as risky as it seemed. 2. The market spends 5 to 7% of its time at all-time highs. That's normal, not rare. 3. Consistency always outperforms timing. 4. The market's best days usually come right after a crash. Don't step out. 5. Diversification and a long-term horizon can protect you even in worst-case scenarios. So the next time the market hits a new all-time high and your gut says, "Let me just wait," well, remember this video and this research, because the data is clear. Consistency is more powerful than timing. If this video was helpful, hit like, subscribe to the channel, and let me know in the comments. Are you more like Alex or more like Priya? See you in the next video. Until then, invest wisely.